Welcome back to the deep dive. We've just been digging into the State of the Dapp Industry Report for Q3 2025. And what we found is, well, it's a picture of real contradiction, almost existential, you could say.
Yeah, the tension really defines the whole quarter. I mean, on one hand, you've got this amazing financial maturity, record capital depth, huge tech evolution. The industry looks, stronger than ever in some ways.
But then the other side is that overall user activity, well, it fell off a pretty significant cliff.
Exactly. Fewer people, but way more money. That's the puzzle.
Right. So our mission today is to kind of give you the shortcut to understanding this new landscape. We need to figure out where user attention is actually going, where the capital is concentrating, and what this whole contraction really means long-term for dApps.
Yeah, we'll hit the big things. The user trends, DeFi hitting these crazy records, how NFTs have totally changed shape, and of course, the security side of things.
Okay, let's unpack this.
Maybe starting with that big picture, the user contraction.
Yeah, let's do that. So overall dApp activity. The numbers are, well, they're pretty brutal. We saw an average of 18.7 million active wallets daily.
Which sounds like a lot, but context is key.
Right. It's down 22.4% from just the previous quarter. That's a big drop.
And it wasn't spread evenly, was it? That drop tells a very specific story.
Where did the losses hit hardest?
It was heavily concentrated in those sectors that were running hot on hype earlier this year. Think SocialFi and those AI projects.
Let's break down those numbers because they're quite something. AI dApps went from, 4.8 million daily wallets?
Down to 3.1 million, a significant cool-off.
But social dApps, wow, they fell even harder.
Oh, yeah. From 3.8 million daily wallets down to just 1.57 million. I mean, you have to see that as a purge, right? A purge of that early speculative froth.
Remember all the talk 6 months ago about a Web3X killer?
Exactly. And this is the market just delivering a pretty cold dose of reality.
And you see it in specific projects, like Virtual's protocol launched big, right? Millions of users initially.
And now, it's pulling in maybe 1,000 to 1,500 wallets a day. It's a near total collapse for that segment.
Yeah, the report mentions others struggling too, like the Arena, Layer 3, on-chain GM. Just confirms that trend.
But, okay, despite that contraction in the hype sectors, other areas were actually really resilient. Some even gained dominance.
Like gaming.
Gaming held incredibly strong. It's actually leading the industry now with 25% market share. Then you've got NFTs at 18.5%, and DeFi right behind it about 17.9%.
Okay, but we need that caveat about gaming, right? Is that 25% really active gameplay?
That's the million-dollar question. The report suggests a lot of that activity is still driven by, let's call them, engagement tricks.
Daily spins, login rewards, that kind of thing.
Precisely. Wallets are active because they're farming potential future tokens, maybe. Not necessarily because the games themselves are super engaging yet.
So it raises that question about the quality of the user base that's left. Are we keeping the curious explorers or just the, rational financial actors?
Yeah, the ones maximizing rewards. Which actually leads us nicely into the next area, because that user drop makes the financial strength in DeFi even more striking.
Right. Let's shift to DeFi's financial Everest, as the outline called it.
Yeah, it's huge. Total value locked, TVL, hit a record this quarter. $237 billion across all blockchains.
That's the highest DappRadar has ever recorded.
Ever. So while retail users might have stepped back, the serious capital definitely stepped in.
What was driving that? Was it just institutions?
Largely, yeah.
Yeah.
Huge institutional inflows, more stablecoin usage, and that whole trend of tokenizing real-world assets. But crucially, there was new regulatory clarity providing confidence.
Yeah, the U.S. Genius Act. That was a big deal, wasn't it?
Massive. It basically gave a clear legal framework for payment stablecoins. Said issuers have to hold actual cash or short-term bonds, like regulated money market funds, essentially.
So if you're managing institutional money, that just removes a layer of risk.
Totally. Before that, stablecoins had this shadow of counterparty risk, regulatory uncertainty. The Genius Act basically said, these specific stablecoins are backed by verifiable liquid assets, legally segregated.
That makes sense. It likely unlocked the door for a lot of that institutional money. They saw stablecoins as safer.
It raises that interesting question. Was this the key? Was regulatory clarity the real catalyst for institutions finally jumping in seriously?
Okay, looking at the chains, Ethereum's still the king, right? $119 billion TVL.
Still leads, yeah, even though it dipped slightly, about 4%.
But Solana took a bigger hit.
Yeah, Solana dipped about 33%, and
Yeah.
significantly that loss really kicked in after the meme coin hype cooled off.
Which confirms our earlier point about that activity being driven by more transient retail interests.
Exactly. That interest evaporated, and the TVL followed. But then you have platforms like BNB Chain holding steady and others growing fast, like Hyperliquid.
The decentralized perpetuals platform.
Yeah, that one grew 29% to hit $2.85 billion in TVL. Pretty impressive growth.
And what does that tell us? That platforms like Hyperliquid are getting closer to what centralized exchanges offer.
Absolutely. DXs are rapidly catching up in terms of functionality. They're offering speed, complex order types, leverage, things you used to only find on a CEX.
But with self-custody.
That's the key difference.
Yeah.
The smart money loves the CEX-like tools, but without the custody risk. So fewer users maybe, but the ones remaining are deploying serious capital with sophisticated strategies.
Okay. Here's where it gets really interesting. Let's take that idea of maturity and apply it to NFTs, because everyone was kind of writing them off, right?
Yeah, the narrative was NFT winter, but Q3 saw a surprising comeback.
The numbers are pretty wild. Sales hit 18.1 million NFTs.
Highest volume since way back in 2022, and generated about $1.58 billion in trading volume.
Okay, but what's behind that surge? New users flooding in.
That's the fascinating part. No, the number of traders only went up about 28.6%, but the number of sales jumped 158%.
Whoa. So fewer people are trading way more often?
Exactly. It implies the existing collectors, the ones with capital, are consolidating positions, trading amongst themselves much more actively. It's not a new hype cycle. It feels more like an asset consolidation cycle.
And the type of NFTs being traded shifted too.
Big time. Gaming NFTs, which rely more on that broader user base we discussed, actually fell 17% in volume.
But sports NFTs
Exploded. Up 337% to $71 million in volume.
And that's mainly Sorare with their fantasy sports leagues.
Yes, Sora is driving that. Fantasy basketball, baseball, football. It shows a shift towards users engaged in complex strategic activities, people willing to invest real capital in competitive digital assets. They're sticky users.
Marketplace innovation helped too, right? Like OpenSea's token campaign.
Definitely boosted activity.
Yeah.
OpenSea saw about 9.3 million NFTs sold, up 29%. And we saw the old blue chips get active again. Punks, Moonbirds, BAYC, Pudgy Penguins.
The Moonbirds acquisition was a big story.
Yeah, Orange Cap Games buying them drove a lot of volume, like $88 million. And the promise of that new BIRB token on Solana got people trading, signaling real investment, and restructuring.
But the really fundamental shift, maybe, is how NFTs are evolving beyond just PFPs. They're starting to merge with real-world assets, RWAs, and even DeFi.
Right. Take Courtyard as an example. Brilliant concept.
They tokenize physical collectibles,
Yeah.
like Pokemon cards, baseball cards.
Exactly. Things that are valuable but hard to trade quickly. They tokenized about 1.55 million items, generating $145 million in activity. It turns a physical thing into basically a digital share certificate you can trade instantly on-chain. Solves a real liquidity problem.
And then there's stuff like Punk Strategy, which sounds more like a DeFi fund.
It kind of is. It's like this automated hedge fund specifically for CryptoPunks. It buys and sells punks algorithmically, burns its own token.
And gives holders indirect exposure to that strategy without needing to own a whole punk themselves.
Precisely. It's incredibly sophisticated.
So pulling that together, NFTs are really becoming these crucial bridges, connecting real-world value to the DeFi infrastructure, moving from collectibles to, well, functional financial instruments.
Couldn't have said it better. Which brings us to the flip side. The costs of all this complexity.
Yeah.
Security.
Right. The report notes that Q3 losses were actually the lowest this year, around $434 million, which sounds good.
Relatively speaking, yes. But the takeaway isn't just the amount, it's how the money was lost. The attacks are getting smarter, more targeted.
We saw some big technical breaches mentioned: BTC Turk, GMX V1, CoinDCX, UXLINK's multi-sig issue.
Yeah, complex technical failures. But the single biggest loss reported wasn't actually a code exploit at all.
It was that social engineering scam.
$91 million worth of Bitcoin.
Yeah.
Lost through one targeted scam, targeting a person, not a protocol. That really shifts the focus, doesn't it? From auditing code to, well, securing the human element.
And the irony is just unbelievable. The hacker behind that $21 million UXLINK exploit.
Yeah, they apparently got phished themselves later, and lost $48 million to the stolen funds.
Wow. So the attackers are falling victim to their own methods.
It really highlights the rising sophistication, especially AI-driven social engineering. The attack vector is moving decisively towards human vulnerabilities, credential theft, not just finding bugs in smart contracts.
So what does this all mean? Let's try and wrap this up.
Well, the quarter was defined by that user-based shakeout, right? SocialFi, AI, they cooled off dramatically.
But the core foundations, DeFi's capital depth, the innovation in NFTs connecting to RWAs and finance, they seem stronger than ever.
Absolutely. It feels like a story of resilience, but also rapid evolution, prioritizing capital efficiency maybe over just mass retail numbers for now.
Final analysis then. From that record $237 billion TVL, partly secured by clearer regulations, to NFTs becoming financial tools. The industry's maturing, it's building more professional financial structures. The focus is shifting to high-value sustainable activity.
Yeah, the froth is gone, maybe. What's left is getting more serious.
Okay, so that leaves us with a final thought for you, the listener, to chew on. If the biggest security threat is increasingly human-focused social engineering, phishing, how does this decentralized industry effectively protect its most centralized points of failure, which are, us, the users?
It's a huge challenge. It means vigilance is needed everywhere, not just in the code audits.
Something to think about. Stay vigilant out there.
Indeed. Thanks for tuning in.